Great, thank you, Sally. So I guess I'm just going to start with a quick introduction to myself for those of you that might not have seen my face before. My name is Claire Quigley. I'm the nature economy specialist at Plant Life, but today I'm here with a slightly different hat on, and that is in my new position as co-chair of this Nature Finance Pioneers group. So really excited to be here and have this opportunity. But of course, you're not here to see me today. I'm simply here to chair and manage any questions. You are here for the event, Financing, Scaling and Securing Nature Restoration Projects Through Insurance from Will, who I have the pleasure of introducing today. But before I do that, I'm just going to go through a few housekeeping rules, which I hope I remember. Sally, please correct me if I'm wrong. So today we are going to be recording the session. Of course, if you don't want to be recorded, please turn off your camera. We do, though, at the end, as we're going through, please put all of your Q&As, please put all of your Qs into the question box, and we'll try to answer them at the end. Of course, upvote any that you see that you're interested in hearing the answer to. And we will ask as well for you to turn on your camera and microphone at the end to ask the questions. That would be great. Of course, if you're in a loud environment and that's not possible, then we can ask the question for you. So then on to Will. Will Butler is the founder and CEO of GaiaSicura Limited, the world's first specialist insurance brokerage dedicated entirely to nature. With a background in global insurance brokerage and risk advisory, combined with a lifelong passion for nature, Will spotted a gap that nobody else had filled, using the power of insurance to de-risk and unlock investment in nature restoration and natural capital projects. I know certainly at Plant Life that we've already benefited from his expertise for our own projects, so I can say with confidence that he knows his stuff. So with that being said, Will, over to you.
Lovely, thank you. What a tee up. And yeah, it's saying that I know my stuff is really applying the pressure here as well. So thanks very much, Claire. Thank you, Sally, for organising. And hello to everyone on the call. I think I've met a few of you, not met a few of you. So for those that I have spoken to, hopefully you'll find this and in addition to what we've already spoken about, and those that I haven't spoken to, hopefully this is not starting from a halfway down the line. And I'll try and run through everything methodically so it's understandable. But as the guys have said, please do pop questions in. What I'll try and do is go through everything within about half an hour, and then leave plenty of time, half an hour, 40 minutes, and leave plenty of time for questions, because there are quite often a lot of questions in this space. Insurance has an obvious crossover with nature, with resiliency, and with the sort of the topics of the day, and both from what nature can do for insurance and from what insurance can do for nature. So I'll try and address all of the points as I can, but yeah, as we said, there will be plenty of questions, and I'm more than happy to answer them as we go. I'm going to share some slides, and we're going to run through those and sort of boil down from a sort of a broad perspective down through to the practical, and hopefully it'll have applicability to everyone as you go. So if I can press the right buttons here, we may be a startup type company, but I do not have the technological prowess that many of my peers do. Here we are. The acronym AIs and shivers down my spine. Here we are, good. So first, Sally, can you guys see that?
Yes.
Marvellous, fabulous. So our tagline is securing a future for nature. And, there is a bit of a buzzword, but I think there is a real imperative now to get on with practical solutions for working out how we get nature regeneration going at scale. And our aim is to do exactly that through insurance. I'm no good at planting trees, sadly. My brother is a wildflower farmer. My dad is a farmer. They're great at the practical stuff. I'm a bit useless at that, but what I am rather good at is insurance. So trying to apply it in a way that makes sense for projects, for funding for this kind of work. There's a bit of spiel about it, so I'm not going to go through it. This isn't a marketing call, this is a practical call, so I'm really keen to just get into the nitty-gritty. But just so you know who I am and my background, I've spent the last 10 years or so working in the specialist insurance market, particularly in the construction space, which has a lot of crossovers to nature regeneration. We talk about physical assets, and we talk about esoteric value attaching to those physical assets, whether that's the value it provides, don't really like that phrase. I'm sorry, I'm going to use a few phrases like that, like describing nature as an asset and esoteric value and all the rest of it. But that's the language that finance speaks, and that's the language that we've got to be able to talk when we're coming into this space. My background is with Marsh McLennan, specialist insurers, and working on very large construction projects around the world. I have worked on BNG from a sort of general discussion perspective, biodiversity net gain down in England for a few years now, having a few conversations about that from the insurance industry perspective. And I also work, set up and chair the Nature and Sustainability Committee for the Insurance Institute of London, which is a CPD committee, so getting together insurance companies to talk about what we can do for these spaces. So I'm going to go through quickly into the next bit. Hold on a second. Apologies, I've shared the wrong slideshow. Give me 2 seconds, I'll stop sharing that one. Okay, I'm gonna have to hold it like this because it's trying to upload itself and do all sorts of clever things, but that's no use to man or beast at the moment. So hopefully this will be enough for everyone to see until it can figure out what it's doing. So just quickly, starting at a macro level, we've got the insurance market has 2 real layers to it. I mean, there's a lot more, but this is the sort of the basics of it. You've got insurance brokers and insurance companies. So the insurance broker should operate on the client side of things exclusively. They work for a client to analyze risk, to sometimes provide advice as to where risk can be mitigated, and at other times then transfer away what risk cannot be mitigated and reduced. And that can mean all sorts of things. That can mean, finding insurance policies. It can mean providing risk advisory services around where insurance policies can't fit. But fundamentally, projects, particularly when we're looking at new markets like nature and similar, we don't have fixed one insurance policy applies to everything, especially because we're looking at evolving timelines across these projects. And so a broker should be analysing the individual areas that are applicable, where risk can be transferred, and applying particular policies for those areas and those time points within the insurance, within the project timeline. The insurer on the other side of the table, and examples of brokers are us. We're a broker. We have Howden, Lockton, Marsh, Aon, Willis. Smaller brokers like PIB, Brown & Brown, those are all brokers. They do not actually provide insurance specifically. Technically, it gets a bit complicated in some places, but technically speaking, they do not provide insurance policies. An insurer is the person that a broker will go to on your behalf to then provide insurance policies. So an insurer is someone like Allianz or Aviva. In the Lloyd's market, there are lots of different small syndicates that you may come across, like Hartford and Canopius, Kita, Dual, RTO, CFC. These guys are all insurance companies that are providing insurance policies. So they have a product that a broker is supposed to go and find the right version of. And it's very important to know when you're talking to people who you're talking to in that chain and how that all works. And that's just a sort of quite a crucial breakdown of how, when you're getting insurance, things should be approached and the layers within the market that we have. It does get murky when you get these really, really big companies. People blur the lines a lot, and the way that the sort of regulation works, it does blur lines a bit as well. But it's important to understand this is the sort of the focus there, the 2 splits. Now I'm going to touch on this first of all, because it's a question that comes up all the time. And that's why aren't insurers investing in nature? I could do an entire presentation on this, but I'm not going to today. We're going to talk about where insurers can help. The reality is, it seems like a silver bullet. Insurance companies hold risk. Therefore, should they not want to be reducing their risk across their portfolios? And the point is, they are at a macro level. We are seeing investment from the likes of Aviva and others, and QBE and various others who are doing investment and things like that. For the most part, though, it's still limited to sort of corporate sustainability and marketing, quite frankly, rather than really big systematic investments going on across marketplaces. Might ruffle some feathers saying that, but we're independent, so I don't really mind. The reason why insurers aren't investing at scale is particularly because of these four issues. There are others, but these are the four main reasons why. You could call them excuses if you were cynical, but I'm not going to do that. First one being the free rider issue. The free rider issue is obviously insurer A, and this is true across banks and across mortgages and all the rest of it. But if you have an insurer A investing money in a solution, let's say a flood management project, then that obviously makes a lot of sense. And over the 10 years, their risk profile may reduce. But insurer B and C is also insuring houses and commercial property within the catchment area of that natural flood management project. So they get the benefits insurer A has paid for. It's a bit of a cop-out, but it is a significant, obviously, commercial reason why people won't get engaged. B and C didn't spend any money, but they're getting just the same benefit. That ties in quite well to the annual insurance cycles as well. Because insurer A insures something this year, there's no reason they're going to next year. All the houses in a village may be insured by Aviva 1 year. The next year, though, they could be insured by Admiral. There's no reason why, they could come in, they could undercut the market. So again, it's the same thing. They put the money in, but there's no guarantee they're going to see the benefit down the road. Third, we've got reinsurance, and this is where we get into the slight dark arts. Reinsurance, insurance companies do not hold 100% of their own risk. So they take on policies and they take on risk from businesses and individuals, but they will then also buy insurance policies themselves against that risk. And that can, for catastrophe type insurance, so flooding and the like, that could be up to 70% at times. So you may be giving them, let's say, £100 worth of premium, but they actually are only retaining 30% of that as risk themselves. They're ceding, is what we call it, away to other insurers. And finally, insurance isn't mandatory. We have insurance for, it's not mandatory for insurance companies. The insurance companies themselves do not necessarily have to place a policy. It might be cheaper for them to simply stop writing a type of risk, to simply stop issuing policies, than it is for them to actually go and invest in mitigation measures that they see as being higher risk to them. Now, that is a very cynical view. I need to really heavily caveat that. It's a very sort of, this is the reason why, doom and gloom. There is a lot of work being done behind the scenes on insurance companies, by insurance companies themselves, and getting involved in the investment side of this. But in order to do that, we have to have a better marketplace. There has to be a way of enabling systematic investment for any financial institution, because they have significant requirements on where they put their capital. So how can insurance help scale a market or a project? Same question, different scale. So realistically, to get markets scaling, to get them moving, you need to have high amounts of investment, you need to have large amounts of revenue, and you need to have confidence. And it's confidence in the delivery of what you're providing that is taught, that the investment and the revenue hinges on. I would probably argue that we've hit ceilings with investment and with revenue. One or the other dependent on what type of project and where we're going. My argument, I think, is that we're probably getting to a point where we're not seeing the flow of capital we want to be seeing. We're not seeing the amount of revenue we want to be seeing. That is true at the project level. That's true up at the market level as well. So the last bit is confidence, and I think we haven't hit that ceiling with confidence because there is limited confidence. There's limited sort of structural confidence across the board. Confidence comes from mitigation of risk. It comes from the management of the businesses. It fundamentally comes from assurance. What can you do to assure entities that you are a good investment or that your product is good? And whatever you can't do to get to that point is then transferred with insurance. And frankly, I don't think insurance is playing the role it can be playing. I think the carbon market, just as a brief example, the carbon market, only about 4% of carbon trades are insured. So there is a significant, if that, and I think there's a significant room for improvement in that scale. On all these other natural capital or commercial regeneration projects are seeing the same thing. So how can insurance then play a significant role in boosting confidence in a project? And we're getting into the nitty-gritty now. So I thought I'd throw up an example of a sort of a bespoke project insurance. This is a very rough web, I would say, of what a project investment or project delivery, contractual web would look like. You have your upfront investment or your prepayment of units or whatever that, your grant funding, whatever it might be. That comes into either a landowner or a project developer, sometimes both, to deliver the project. You then have a unit purchaser, whether it's biodiversity, whether it's credits, carbon credits, whether it's something else. You could even change that for a service buyer, depending on how you like to use your vernacular. You've got contractors, you've got third parties getting involved, and the money flows in a circle back round to the investor to pay off the investment. Now, if any of that breaks, anything in that train, you've got a loss. You've either got a financial loss, you've got a physical loss. There is something that could go wrong, but it looks complicated. But fundamentally, if you sort of squint and change the word unit to house purchaser at the end there, you've effectively got a construction project. And so when we start looking at these not as bespoke, clever, and fundamentally different things, which they are, I should caveat, but in the eyes of things like insurance, the closer we can get them to these comparables, the easier it is to apply. And that's the same for funding and the same for anything else. If we can translate these things to people who don't understand the baseline complex ecology and things into a way that they can, you get a lot further. And so that is very similar to a construction project, as I said before. And so what are the four key insurance areas when we're talking about these projects? We've got restoration cover, which is the cover for any costs on site to get you back onto your delivery plan targets. We've got replacement cover, which is the cost to replace units and credits that you may have committed to, but you've not delivered, whether from a regulatory perspective or from a market perspective. We've got non-payment cover, which is really there for investors, for banks, and for the project developer. Oh, sorry, just very quickly, because I know there's a lot of different backgrounds here. When I say developer, I mean nature project developer. I don't mean house builder, just so everyone knows. I'm going to make that mistake loads of times, and I really need to break a habit of a lifetime with that one. But nature project developer is what I mean when I say developer. So if you have an investment or you have a loan or something like that, you can insure that against default. And that obviously provides a huge amount more security for the investor, whoever's money is going in on the upfront basis. And finally, there's the general insurance. That's the one that's are non-specific, are not that, are not reinventing the wheel. They're probably just changing the tread on the tire, if that makes sense. The big one there being professional indemnity, which we'll get onto. So how do these four work? Restoration policies. I'm sorry, I'm fully aware this is a huge data dump. There's a lot going in all at once. That's the point of these things, but I apologize if I really am open to any and all questions. So we've got these two types of insurance that work in tandem here. We've got restoration insurance and we've got replacement insurance. Those aren't technical terms. Those are the umbrellas that we've put over them because there's lots of different types depending on what you're doing. But fundamentally, they look at addressing the same types of risk. Restoration, you're looking at what can happen on a site. You're looking at the damage caused by a fire, or you're looking at someone going rogue and chopping down half your trees, or you're looking at the banks bursting on your river that you've been trying to re-wiggle, which is my favorite technical term. This is cover to keep you on track for whatever your delivery plan is. It boils down to the very, very basic, which is like your standard forestry insurance. So we could be looking at things like fire, flood, and wind cover that knocks over trees and pays to replace them. Or you could be going all the way up to all physical risk, all trigger cover that can then be looking at the habitat management plan itself or the regulatory obligations on site. In tandem to that, because a lot of the nature regeneration projects we look at and we work with are involved in some form of natural capital market, we're looking at replacement. And so replacement looks at either the regulatory requirements you have around uplift, so fines in excess of what the physical value could be, fines is a dangerous word, but payments that you need to make in excess of what the physical damage costs on site would be, or the restoration of the site would be, or the costs of a unit that you have sold, so a transaction that you have entered into, a contract of service that you have entered into, to replace that value. And so that's a little bit like if you are, you're selling your house and you have an indemnity policy for the value of the house rather than just for the value of the bricks and mortar. It's in excess of what the physical restoration of that would be. Fundamentally, it works very similar to a product guarantee. So if you are selling a product and you say it's going to do X, you can have a guarantee that confirms it will do X or you'll get your money back. For carbon credits and things like that, it can even actually just replace like for like on the credits for some types of insurance. Now, those two work well in tandem, because if you don't have the restoration, but you do have the replacement is looking at absolutely everything that's happening, is replacing the whole lot. Quite a lot of the time, as we all know with nature, if you go in and you sort some things out, you put back the right type of tree species, or you repair the bank or whatever it might be, you can actually stay on track and you don't lose those credits or those units or whatever it might be. You can actually make it all work on the site. And so that fundamentally reduces the exposure, we would call it, to this type of insurance. So the two work very well together. They can either work, there's different kinds. Generally speaking, you want to run your insurance as long as possible, so you're providing that security to buyers and investors. And so a policy can run up for 10 years. However, that might, we can do what is called a long-term agreement, which is where you effectively lock in your insurance to renew the policy after 10 years. And so if you have a buyer that's saying you have to have something for the whole 30 years, if it's a biodiversity equivalent, then you have a guarantee from the insurance company that you will be renewing your insurance policy, and therefore fundamentally you have that policy in existence. So it satisfies your contract certainty, and it helps satisfy the legal element of things as well. So I won't. That's kind of the core fundamentals when we're talking about things like habitat banks or natural capital projects, carbon projects, which I know is a lot of the focus for what people will be thinking about here. And these can be taken out by whoever is, whoever has that liability for the project. So it could be a landowner, it could be the stakeholder, it could actually be a third-party entity that's working across multiple sites and has liability for the sale of the credits or units. You don't necessarily have to own the land to take the policy, and quite often, particularly the restoration element, will be tied to the land itself anyway. So even if there's change of ownership and things like that, you can have a certainty throughout that change of ownership that things will continue as is. Final thing on this one. What we try and do is work out the cost of the insurance before you need to have it. That's pretty crucial, because if you're going into a negotiation with someone and they turn around and say, that's great, but I want insurance, XYZ insurance on this, it's much better to have already incorporated the cost of whatever that was into the price of the unit from day one. So they're not suddenly you're not having to wear that cost. The project isn't having to wear that cost, whoever it is isn't having to wear that cost. It is an operational cost. So you don't have to pull the trigger on the insurance unless someone asks for it, potentially. You may want to, but it's much better to have it priced up and in place and ready to go before you're asked for it, because otherwise it's going to feel like an in addition, where realistically, if we were in any other market, this would be as standard. So I'll move on from that one, and I'm sure I've missed some bits, so please do fire some questions as we go for the end. So non-payment insurance, this is an evolving market. This is effectively looking at things from the investment perspective, the supply perspective, whereas these two perhaps look a little bit more about on the project and they're going back up to the end buyer. This looks more at the investor, the supply side, if you like. So what this effectively does is it covers you against failure to repay. It's a very normal type of insurance, and it's what's often called trade credit. And ultimately, it's underpinning your obligations. And so, you might have a requirement that you're going to start repaying your loan in year 5, but a fire wipes you out, takes a little bit of time to get insurance repayment. You can't start repaying that loan. So you've defaulted on your loan for that first year. the insurance can step in to cover that cost as you get your financials in order. The other insurance comes in, pays back, and makes you whole again. So these interlink, but that is a really good way of, again, mitigating that risk from the supply side perspective. And again, when we're talking about the project side of things, we can get engaged at any level, we can get engaged at any stage to make sure that the costing and everything is looked at in advance and you can understand what that will look like. But fundamentally, it's quite simple. You have a loan agreement or you have an investment agreement, and this underpins it. And it's a very normal type of insurance in the rest of the financial world. And I was just talking with someone the other day who had managed to do something like this for a seagrass project in the Bahamas, which I thought was phenomenally interesting. So these things are being applied to nature. Some of you may come across some insurers like Kita, like CFC. The chestnut deal that CFC, I think, did was it was made the papers. There was this kind of insurance. It's that protecting the investment amount. They're very close partners of ours that we work with on this kind of thing. And finally, it's the general insurances, the things that you probably either have or should have anyway. These are your standard business insurances. What's really important to understand is that what you get off a shelf works really well for established markets. Generally speaking, things like employer's liability, fleet insurance, public liability, all these are normal, standard off the shelf. You want to take a look at them. You want to make sure your broker's taking a look at them. They're not overlapping with other kinds of insurances, but for the most part, you should be all right. Worth flagging, property insurance generally only covers property in terms of man-made assets, so barns and buildings and that sort of thing. It won't be covering physical assets, sometimes different, sometimes not, but it's worth just reviewing, making sure those are all fitting, but also that they're not overlapping with anything else, like the more sort of nature-focused stuff you might be looking at, because you're just paying double effectively, and that's pointless when we all know how much money is going into the nature regeneration world. But the last one to look at is professional indemnity, and that's pretty crucial. It is something that we're seeing a lot in the market that buyers of natural capital are requiring people to have, because fundamentally what it underpins, your standard professional indemnity will underpin a delivery of professional service. And that can be ecology, it can be environmental advice, it can be broking, it can be all sorts of umbrella term for professional services. We've just developed our own type of PI, which goes one further. It's something called a civil liability insurance, and that is a far wider umbrella and looks at contractual liabilities as well, and incorporating some environmental liability as well. So if you are a third party that's operating in this space, or if you are, you're providing broking service, you're providing advice, even if you're doing that internally and you are delivering units and things like that, professional indemnity is probably the one that's going to crop up time and time again as a evidence you have this, or you must have this. If you're setting up SPVs, things like that, we've got to make sure it's all wrapped in, because it is something where people are being asked for again and again and again. Finally, I wanted to just go through a bit of an example of what this looks like, because I know there's a lot of higgledy-piggledy all over the place with the last two. So we'll just have a look at this. This is a timeline, if you like, of 10 years for a project, and let's call this a carbon credit delivery project. One very like this that we've worked on. Luckily, it hasn't gone all this way yet, but looking at the insurance for it, this is generally how it operates. And so if you have an investor rather than a prepayment setting, and let's say somebody is prepaid for all their credits in year zero, you're confident you're going to get as much as you need, and this is your HMMP line here, or HDP, I think it is for carbon credits, going up this line here. That's the uplift on nature, and therefore the credits that you've got as a result coming along here. Financial guarantee is protecting the investor, so things progress over 5 years. All well. Suddenly, though, here, the darker green section, we've had a loss. And let's say there's a fire has happened on site. So actually, a little bit of worry there. They prepaid some credits, you're not getting them back. So if there was a financial obligation by year 5, that financial guarantee, or the non-payment insurance, as it's called, steps in to repay your investor and to make sure they're whole. They then exit, they're quite happy, they've got their money back, and you are then left to continue with the project yourself. But you've had a fire. And so whilst that's made them whole, what's going to happen on site? You've got the restoration type insurance, pays you to plant a load more trees, load more saplings, get you back on track, and you're continuing your project up here. Growth's really good. We're having you've overcooked the numbers a little bit anyway, so you're looking good, and you're getting up to where you thought you'd get to as your maximum point here. Unfortunately, some numpty drives on the side with a big old diesel tank, spills a whole load of diesel, and just completely destroys a serious area of that tree, that forest that you've been growing. So fastidiously, you can replant a few of them. So your restoration policy kicks in again to replant a few of them. But fundamentally, the ground is poisoned, and you're not able to do the full uplift back on track that you were anticipating for the issuance of 10 years. And so, unfortunately, the people who are prepaid for carbon credits, they were expecting this amount here, they're only getting this amount here. And so there's a gap. And the final replacement insurance steps in to fix that gap, in effect, to make the buyers whole, those pre-buyers whole. And so they don't sue you. You're quite happy carrying on. You've had your issuance point, the baseline gets re-established, and you start again for the next 10 years down here. And the whole time, you're making sure you've got your ongoing insurances to step in across the contractual web. Crucially, you need to make sure that your insurance and everyone else sitting around you overlaps in the right kind of way. And again, this is why that broker part, the split of the insurance industry, is really important. One policy very rarely does everything. Certainly doesn't do everything for everyone involved. And I don't really know many businesses that are doing absolutely everything from the physical work, the ecology, soil core testings, baselining, standard checking, regulatory checking, all the rest of it, all the way through. In fact, none, if we look at it that way. So if you have obligations, if you have liabilities, it needs to be looked at and it needs to be checked that everyone else has got what they're supposed to have. Finally, I'll just say everything we've heard about here from a specific project specific can also be done across portfolios. It takes a bit of work. We're looking at, splitting. We're looking at sort of pooling risk together across a wide portfolio. So if you are a third party entity that's working across lots of different sites, maybe if you're a broker of carbon credits, whatever it might be, you can look at this. You retain some liability at some point. We can look at it across the entire portfolio so that either it's a great value add for buyers you're talking to, or if you need additional investment for each site, you've got that in place across all your policies. Usually they renew annually rather than going over the big long term, because you're going to be adding projects and adding different things, some dropping off, whatever it might be. But you can do it across the whole portfolio as well. And finally, is that not finally, this is an insurance. The advisory part is important, like I say. Check where you can mitigate the risk, because if you've got a load of it sitting on your books, insurance is going to be expensive. First thing to do is to make sure that you're getting rid of as much as you can by carrying out the right kind of assurance and the right kind of internal checks. And worrying about people. People think with nature that the biggest risk comes from nature. It doesn't. It comes from other people. It comes from somebody carrying out baseline, or it comes from somebody going bust in the contractual chain. It comes from a landowner changing their mind and deciding to bulldoze half a site, or the other way around, you're a landowner and your delivery entity has signed you up to a whole load of liabilities you weren't expecting. So it needs to be looked at across the whole lot. You need to look at the people you're working with and make sure everyone's in sync with the risk. And I will stop there because I'm very conscious I've waffled on and the technology has done me dirty on it. So I'm going to stop sharing and I'm going to have a look at the chat and the Q&A and see if there's any questions to jump into. I think everyone's been chatting rather than using the Q&A as I mentioned mine. Over to you, Claire.
Yeah, it seems like that. Thanks, Will. That was super interesting. I always find it so fascinating. The world of insurance is, I don't know anything about it, and I'm constantly amazed by all the different angles you can look at it from. So we are starting to get some questions. One question in the Q&A, and I know I can see Mark and Michael here have been talking about a little bit about pricing. I might just be a little bit cheeky and come in with a kind of umbrella question around pricing, a bit more general one to start off that conversation. You mentioned that some woodland, I can't remember the percentage you said, I know it was quite small, of woodland carbon projects are investing in insurance. I was just wondering if you had any idea of the price of those credits versus non-insured credits, and if there's a greater demand for those.
So it's difficult to tell if it's specific to the Woodland Carbon Code, because the Woodland Carbon Code has very little number of credits insured. So the global credit trading numbers is 4%. Woodland Carbon Code is probably much lower, and that's because of the quirks around the long issuance periods. And we can talk for hours about that 10-year period being a bit of a hamstring when you compare it to other types of standards, but fundamentally, the information we receive, and I can only go anecdotally, I'm afraid, because there just isn't a statistic on this yet. I've been talking to a few people like Beyond Zero and things like that about this, allied offsets and the like. But fundamentally, we just don't know what the market statistics look like. Anecdotally, insured credits hold a much higher value because they are seen as much lower risk, obviously, because you're getting them. There is no, if you have the insurance, the delivery insurance, the replacement insurance, as we call it, you're getting what you paid for. And so there is a higher value associated with that. The actual cost of those credits going up is, I'm not sure. Some people have thrown 30% at me, which is obviously great. But you'd have to talk to a specialized carbon broker on that instead. In terms of, because I see a lot of the questions are probably going to be about price of the insurance, so I'll head that one off now as well, because I know that's going to be a significant question. First thing to obviously highlight is that a lowland meadow project with a 30-year uplift requirement and very little third-party involvement is going to have almost no insurance cost whatsoever, because the risk is very, very low. A river rewiggling across an entire catchment with 40 different entities and commercial farms and things like that involved is going to have a higher cost because it's got a higher risk profile. The reality of it is the costs of the insurance are lower than you think, but it is important that you should be getting those costs sorted prior to talking about the price of your units, because if you sort the price of your units or your credits out and you go to market with them and then turn around and realize you need insurance, it's going to be in excess. That cost is going to sit on you. It's no longer an operational business cost. It is an extra add-on that you're lumped with. And we can sit and talk to the buyer and tell them that, well, they need to go get it, but it's going to be a bit of a tricky conversation in a very buyer-dominant market. Generally speaking, for carbon, and this is a huge generalization because we're talking about global carbon pricing, we would be looking at what we call a rate of the insurance, anything from 0.5% of the total insured value all the way up to 5% of the total insured value per year. And so whilst that may sound scary because we're talking about selling in 100 years in advance, there's ways of working that mean you're only sourcing the insurance for what your liabilities are at the time, and whether that time frame is that year, whether that time frame is 10 years, that's how we arrange it. It's different for biodiversity net gain, for carbon, pure conservation and physical risk. It all changes. But BNG, I think I see Phoebe's mentioned BNG here in the question, how do you secure BNG offsite insurance when it's becoming difficult to secure? I think generally speaking, it should be getting easier because the market is starting to understand it. We're starting to understand what the regulation risk is. We're starting to understand what the step-in rights look like, how the conservation covenants line up. Conscious Scotland doesn't have a sort of a mandatory equivalent yet. And it's really important to understand how that's a contractual risk at the moment rather than a regulatory risk for the most part when we're talking about voluntary units. But again, it really depends on what you're signing up to, and it depends on what your liabilities are. Fundamentally, for something like BNG, if you're signing a conservation covenant that means that you have to replace the entire value of your unit, if something goes wrong, you probably need to go and rethink your conservation covenant. If the regulation does not necessarily require you to do that, there's a lot of leeway, I would say, in how it looks for offsite. You want to be looking at where your risk sits. You know, you have a maximum threshold. You have 30 years that you want to be doing this uplift for. If you're not getting to that top bit, do you have to go and buy replacement units? If so, look at the insurance for that, because you don't want to get a year 20 and have to suddenly fork out £500,000. The insurance can cover that. So, and again, it's done on the value of the total insured amount. So insurance looks at what is the maximum amount that the insurance company will pay out, and then it'll do a percentage of that maximum loss as your premium price. And as I've said, we can pre-price this stuff 30 years out almost. So let's make sure that that is getting incorporated nice and early. If it isn't already incorporated, there are other ways of working around it, and you can. I'm more than happy to sit and have a chat, but it would derail the entire thing if I went into that now.
Yeah, no, very interesting. Mark Reed here. I don't know, Mark, if you want to ask your question out loud. I am also very happy to ask it for you. I'll give you a minute to appear. Oh, there you are. Hello.
No, I'm here. Yeah, thanks. Really fascinating. So, yeah, I've asked a bunch of different things, but I guess it's primarily around comparing and contrasting insurance versus pooled buffers. Just in theory, at some point in the future, this could be an alternative approach to managing risk in these markets, built into the market. Into the crediting program itself. ICVCM doesn't allow it yet, but it looks like they might consider that in future. So this is quite a putative kind of question, but I'm still interested in principle. What do you see as the key advantages of insurance versus buffers and other risk management techniques that we've already got built into our standards? And yeah, can you also consider the cost differential, just in terms of quite a substantial amount per project being put into buffers? If you could not have to do that, do you think insurance could actually make projects significantly more viable financially, or is that a bit of a pipe dream?
Well, no, I think that's actually where insurance has its best application at the moment, if I'm honest. Well, not at the moment. It's one of the very good applications. It's already being applied in the other spaces, but I think that is the best future application of it. And actually, we are seeing it being applied. Vera, the standard, has just released its durability pilot, saying that it's asking projects that are under the Vera carbon code to look at replacing their need to put into the buffer for issuances coming up over the next 3 years, replacing their need with insurance policy. Now, it's very important to understand the differential here, though. That is insurance for already issued credits, so credits that are being retired. It is not insurance for the pre-sale of credits. So it's any that are being issued and being retired within this year. Obviously, you need to put, I think 20% is the sort of general standard, into the buffer. Vera are saying that if you have an insurance policy that will cover you for any cancellation of already issued credits, then you don't need to put them into the buffer, or you only need to put a certain much smaller percentage. Personally, I think the focus currently is on that pre-sale element, because we haven't really had many issuances, particularly in the woodland carbon code. I think we're only coming up to the first ones now. So I think we've got a little bit of play to look at with that. That is a big transactional risk. The market obviously makes a lot of sense to move towards replacing buffer pools with insurance, because fundamentally that's what insurance is. You do have this enormous financial beast that is sitting there on trillions of dollars across the world that steps in to take that risk off transactions and to free up what is effectively revenue. If we have enough demand in the market to be buying all the credits, quite a big if, then you will be seeing if you're putting 20% in a buffer, that's 20% of your revenue. You're just tying up, or you're losing effectively. So from a financial perspective, it makes a huge amount of difference. If you've got, even at 10 years, let's say your insurance cost is 1% per year for 10 years, that's 10% of your project value. That's quite a lot. That's fair enough. But if that then means you can release 20% more credits and you're selling them, you're 10% up. So and the insurance prices are coming down. So it's a significant difference. And that's a long issuance period. 10 years is a long issuance period by global standards. So I think from a market change perspective, that is that's a big opportunity. But I will caveat with, I don't think we should do away with buffers entirely, because the insurance is not going to be applicable to absolutely every kind of credit or every kind of project. You don't need 20%, 2 or 3% going into a pool. I do think there's an opportunity there. And I think having, the buffer pools themselves can be insured against depletion. So, that's reinsurance. It's that next stage in the sort of the dark art. But I think I do think that is an obvious development in the market, and we've been speaking to all the major standards about this, UK focused and global. So I think it is important to keep it in people's heads when we're talking about it. But Vera is already doing it, so that's really important. Vera is already looking at it.
Yeah, I was aware of that. I didn't realise the caveat of just how narrow their pilot was. So that's interesting to know. While the carbon are working with Kita to ensure their buffer. I guess probably the reason behind ICVCM's reluctance to allow this is the fact that an insurance product doesn't guarantee that climate mitigation is delivered. And if you want to guarantee permanence of the carbon, getting your money back, it doesn't give you permanent.
Which is exactly that. Which is why I believe the durability pilot does not allow for replacement with finance with money. It's only for like credits. And most of the insurance does allow for that. It's you have the option. Most people, I would imagine, from that permanence perspective, would be looking at the replacement with like credits. Now, again, it goes back to the fact, where do you find those? That's for
which then means your insurance policy is effectively funding an extended buffer across multiple schemes because you're getting to buy from other.
Better to let the $1 trillion asset company handle that than the individual conservation entities there, if you ask me. So I think that's the better option.
But I mean, the principle of a pooled buffer is you reduce risks because you then got you've got multiple projects, and the idea that they would all fail is much lower. But actually, if insurance allows you to replace units from multiple schemes internationally, then you're actually further diversifying and, in theory, further lowering that risk.
It's how insurance pools work across all markets. The difference being we're obviously trying to do the right thing with this market. It is a pooling of risk, spreading that geography out. Any other questions going through? Thanks, Mark.
Yes, maybe to keep on the sort of risk mitigation side, we've got one from Tom here, Tom Ward. I don't know if you want to ask your question out loud, or I am very happy to read it for you.
Yeah, no, thank you. I'm at the RSPB. I guess it follows on from the question Mark was asking about the relationship with or the choice between pooled buffers and insurance. I suppose what I've been trying to get my head around is how an insurance product fits with the risk mitigation more generally, because say in a kind of peatland code context, the market already builds in various types of risk mitigation. So yeah, we're already paying a 20% insurance policy through the risk buffer. It is common for sales of pending issuance units to share the risk with the buyer. The reason that buyers, the benefit of getting the PIUs in advance is usually balanced by taking on some risk as to whether they'll convert or not. So therefore, it is not uncommon for sales to not guarantee that all of them will convert. Or there may be force majeure clauses in there. So I suppose I'm trying to understand the extent to which insurance can be customized so that it doesn't simply we end up paying twice for cover, for mitigation that we already have through a different measure. And I suppose the kind of bit that I'm most, your point about it's people not nature, I think is absolutely right. The bit that looking at a 100-year project, the risks that I think are most significant are, say that we get our financial forecasts wrong, or the restoration techniques that we've been using prove not to be effective, the regulatory and governance arrangements around the market ramp up costs. So I suppose I'm trying to understand the extent to which insurance can cover those risks, rather than, if you like, the kind of more force majeure risks which you were kind of citing in your example, chemical spill or whatever. Sorry, there are a few questions in there, but I'm just trying to understand how this, rather than seeing insurance as a separate thing, how it fits into the broader, how from a project developer point of view, it fits into that broader framework.
Yep, and it's a very good question. I think it's important to understand we're in a specialty insurance market. We're not in an off-the-shelf. You're not going and getting your car insured here. We're talking about something that needs to go through a broker, and needs to go into insurers with a significant amount of back and forth and all these projects. So fundamentally, the insurance can change. We've not worked on one policy that's been the same. Every single one has been different. So carving out what's unneeded versus what's needed is a vital part of the entire placement process. And ultimately you want to be matching to the contracts you are signing up, and that's really crucial. And so half my life I felt like more of a lawyer, which is terrifying because I left law 10 years ago. So but it's an important aspect of lining up the insurance with what the actual risk is, and not going and seeing off the shelf, let's have a look here. And also, it's really important to understand that markets change. We will see an evolution of the market as we go. So what we're aiming the insurance at is the liability within those contracts. If you have pre-sold your credits for 100 years, you're not going to get insurance for 100 years, but you're going to get something that's going to keep them happy within the insurance policy period. And that's got to match up to what contract you're signing. So if you are signing a delivery contract that's really brutal on force majeure, that's really brutal on third-party loss and failure, that says, if the RSPB disappears, they've got to repay us first before anyone else or anything else, let's really hope that one doesn't happen. But it's really important that the insurance then matches that up. And that's more than doable. And then as we see the market develop, insurance can be renegotiated, can be worked to whatever the circumstances are that matches along the contractual requirements. Generally, we see this as being something that enables transactions. It's something that allows for people who are coming in and want that certainty, who don't understand the carbon markets down to a T, who don't understand biodiversity uplift, who don't understand ecology. It's taking that risk off their plate and putting it into something they do understand, which is insurance. And there is a fundamental shift. The market does have risk mitigation factors in place, but those aren't universal truths, and they aren't, it depends code to code. It depends on project to project type. Whereas the insurance, if done right, is a replicable and well understood element that can fill in the gaps, and crucially fills in the gaps. It doesn't need to overlap with those mitigation measures. So if you are giving away 20% to a buffer, and the buffer is going to pay you back 20% in the event of a loss, your insurance policy can sit almost like that's your car excess. On your car, you pay that 20% goes off first, fine, and insurance sits on top. That'll make it cheaper. And that's generally speaking what we do see. So I think there's those elements that are really important things to work out as we go. Obviously, I can't go through all the policy specifics on this, but that's fundamentally where it sits.
Great. Okay. I do really want to bring us back to the Q&A box, because I can see Ben's question is getting lots of upvotes. So I don't know, Ben, if you want to say that out loud.
Yeah, sure. Ben Connor from Scottish Wildlife Trust. You touched on this slightly already, but to comparing biodiversity net gain in England with what we've got currently in Scotland with biodiversity enhancement or positive effects for biodiversity, it's quite a different policy and legislative context. Between BNG, where you've got a statutory compliance market, in Scotland it's policy-led, it's non-statutory. So, for example, if as Scottish Wildlife Trust, we're providing off-site biodiversity enhancement to mitigate the impacts of a construction project, we can contract to sell a service to provide that, but we're not selling a unit or a credit per se. Even if we use it, even if we're using a metric to quantify that. So yeah, just interested in what the implications are for insuring projects. Like some of the aspects. So for example, the kind of replacement insurance, there wouldn't be other units available because we don't have habitat banks. So there's not projects lying around that have units to sell which are not, and the project might be tied through planning conditions. We don't have conservation covenants. So yeah, interested to understand A, what the implications are, and B, whether you just think that's problematic in the Scottish context for insurance?
I wouldn't say it's problematic. I would say that it's a bit emblematic of the market in that it's very fragmented. It's very different different bits all around the world, and we're seeing the same globally. I would say that fundamentally, though, what we're talking about there is a service rather than a product, and it's an alteration to the types of insurance. So maybe you don't need that replacement element necessarily, but if we're talking about permanence, you may want to be building in some element of acquisition of new site to carry out a continuation of carrying out the works that you're doing. Again, you can have, like I was going into detail on the professional indemnity, that civil liability element, effectively your contractual liabilities. What are you signing up to deliver? If you're failing to deliver that for an error or an omission or a failure of professional service, that's insurable under a professional indemnity policy. And so it totally depends on the nuance of what you signed up to. If there's a planning element involved, that's a regulatory liability that can sit with environmental liability insurance. There's all these different aspects. It's frustrating because it sits outside of what is becoming a standard, globally. But it doesn't necessarily mean it's problematic. It just warrants a closer look. That's all. And that's the same for other types. We're looking at a lot of natural flood management at the moment, and that's going to have its own box to fit in. Conscious we're at half past, so Claire, I won't waffle on, but yeah, I hope that answers Ben.
Yes, great. I think we will have to wrap it up there. But thank you, everyone for joining. I certainly